Penny stocks are common shares of small public companies that trade for less than $5 per share. The U.S. Securities and Exchange Commission uses the term penny stock to refer to a security, a financial instrument which represents a given financial value, issued by small public companies that trade at less than $5 per share. Penny stocks are priced over the counter, rather than on the trading floor. The term penny stock refers to shares that, prior to the SEC's reclassification, traded for pennies on the dollar. In 1934, when the United States government passed the Securities Exchange Act to regulate any and all transactions of securities between parties which are not the original issuer, the SEC at the time disclosed that equity securities which trade for less than $5 per share could not be listed on any national stock exchange or index. Over-the-counter exchanges that list penny stocks include the OTC Bulletin Board or OTC Link LLC. Penny stocks can also trade on securities exchanges, including foreign securities exchanges. Penny stocks can include the securities of certain private companies with no active trading market. When considering penny stocks, investors and experts in the field recognize the low market price of shares and its correlation to low market capitalization. Market capitalization, or market cap, is the total dollar market value of all of a company's outstanding securities. Since penny stocks are inexpensive, investors often buy large quantities of shares without spending much money. This tendency makes the penny stock market volatile. Volatility is a statistical measure of the dispersion of returns for a given security or market index. Typically, the higher the volatility, the greater the risk in investing in said securities. Transversely, the lower the volatility, the safer the investment is. Volatility can be also understood as the frequency of large changes in the value of a given security in either direction. This is directly correlated to the price action of a security which, when talking about penny stocks, can change more rapidly than that of a large cap stock. The volatile nature of penny stocks also leaves these companies open to potential manipulation by stock promoters in pump and dump schemes. Oftentimes, investors are led to believe that the ability to purchase large quantities of shares at low prices will result in greater returns, which makes them more susceptible. Prosecutors and the Federal Bureau of Investigation say that fraud is widespread in the penny stock market. Even though the penny stock companies are small, the scams that involve them can be for tens of millions of dollars. The penny stock market has little liquidity, so holders of shares in penny stock companies often find it difficult to cash out of positions. In the United States, the SEC and the Financial Industry Regulatory Authority have specific rules to define and regulate the sale of penny stocks. There are inherent concerns that individuals should be aware of when investing in penny stocks, namely the lack of information that often exists surrounding the companies offering said stocks. The lack of public reporting mixed with a thin market is often the perfect recipe for stock manipulation via stock promoters. A common practice is for these individuals to purchase large quantities of stock and then utilize promoters to artificially inflate the sub-penny stock's share price through false and misleading information. When the liquidity and price increase, the manipulator will sell their stock. This is called a pump and dump scheme, which is a form of microcap stock fraud. On April 3, 2017, the Federal Bureau of Investigation reported on a story in which penny stock fraud was the focal point of the piece. According to the article, California resident Zerg de Maison was found guilty of conducting a pump and dump scheme, during the course of which de Maison and his associates convinced large groups of investors to purchase shares of companies that he had set up as shell organizations. From 2008 to 2013, de Maison created 5 small public companies which, unbeknownst to the investing public, did no actual business and had no legitimate assets. Once he set these companies up, he offered public shares of the company's penny stocks for investors to purchase. According to the FBI investigation, de Maison would use fictitious names to convince investors to purchase shares of his shell companies. thus driving up the price of his shares and giving the illusion that investors were realizing profit. Once these prices went up, the Mason and his original conspirators would then liquidate their shares at the stock's highest level, and this mass selling caused the shares to drop dramatically, leaving investors with near worthless shares. In more sophisticated versions of the fraud, individuals or organizations buy millions of shares, then use newsletter websites, chat rooms, stock message board,